So recently, I had a friend tell me a story about how we're going to end up with mortgage rates at 20% or higher. Is that possible? Is that where we're headed? The theory was that if the federal government doesn't stop printing money, interest rates are going to have to keep going up to curb inflation. So let's talk about that possibility. The housing market constantly evolves with numerous factors influencing various segments. Among the critical elements that buyers, sellers, and homeowners consider are mortgage rates, of course. These rates play a significant role in determining the cost of borrowing money to finance a home. So understanding where mortgage rates are headed in the future is something that we're all trying to do to get a good idea of whether buying a home in the next year or two is going to be a good idea. The last time mortgage rates were close to 20% was in 1981, when they were 16.63%. But why did rates come so close to 20% in 1981? The course of mortgage rates is influenced by a wide range of factors, like the performance of the overall economy, monetary policy, inflation, housing, market conditions, and global economic trends. While predicting with absolute certainty is a fool's errand, it just really can't be done. We can make an informed projection based on historical trends or current indicators, and even just coupling together the opinion of experts. In the late 1970s and early 1980s, the United States experienced stagflation, a combination of high inflation and stagnant economic growth. To control inflation and stabilize the economy, the Federal Reserve, then led by Chairman Paul Volcker, pursued a policy of tight monetary control, the Volcker shock, we called it. The Federal Reserve increased interest rates by raising the federal funds rate, which is the rate at which banks lend to each other overnight. So higher interest rates made borrowing much more expensive, and that included mortgages, of course, but this measure was really intended to reduce the money supply and curb inflation. So the tight monetary policy was accompanied by various other factors that contributed to the high mortgage interest rate. We have an economy that was struggling with high energy and oil prices due to disruptions in the global oil market, which added to inflationary pressures, not to mention the fact that we had been in Vietnam for a long time and were just pumping money into the economy. So we also have to name wage demands and escalating labor costs as a further fuel for inflation during the period, or at least that's kind of what we were told. You don't hear people talking about the cost of Vietnam nearly so much as you hear about the cost of labor. Just a thought. But there are various ways to control rising costs, but the Fed is a one-trick pony, and really their primary option there is just to raise or lower interest rates. Obviously, they found some special things to do with quantitative easing or tightening or that stuff, but primarily it's raising and lowering interest rates is their main thing. Combined, these factors result in high demand for borrowing by the federal government, which increase the competition for available funds in the market. So, demand for mortgages and the cost of borrowing increased, leading to exceptionally high mortgage interest rates. Mortgage interest rates were as high as 16.63% in 1981, like we said, primarily due to high inflation and tight monetary policies implemented specifically by the Federal Reserve in an effort to combat inflation. Understanding the prevailing economic conditions is very helpful to anticipate mortgage rate fluctuations in the future. We have economic factors including GDP growth, employment rates, inflation, that all provide insights into the overall health of the economy. It also makes sense to look at central banks, their monetary policy decisions, like interest rate adjustments. Those impact mortgage rates much more directly. In addition to economic indicators, you really need to examine the specific conditions within the housing market. Factors like supply and demand dynamics, home price trends, and the regulatory landscape play significant roles in the shaping of mortgage rates. Examining these factors in conjunction with the broader economic indicators gives us a much more holistic understanding of the likely trajectory of mortgage rates in 2024. Considering the ever-increasing interconnectedness of the global economy, monitoring international economic trends becomes much more important. Developments in major markets, international trade policies, and the geopolitical events can all influence mortgage rates. Therefore, we need to assess key factors in the global context that could impact mortgage rates, enabling us to have a much more nuanced analysis of where interest rates might go over the next year. The primary difference between the American economy of 1981 and now is that our economy is much more global. The technology that serves that economy is digital instead of industrial, and the demographics of our population have shifted towards the geriatric. The biggest difference between now and 1981 is that core inflation has come down quite rapidly over the past year, whereas in 1981 there had already been nearly a decade of stubborn and rising inflation. A dollar put into an index fund in 1970 might have been worth $1.10 or even flat over an entire decade. So we've already seen rates come down slightly over the past 2 months, and the Fed has said that they would like to bring interest rates down another 50 to 100 basis points. So it's impossible to say if interest rates will for sure come down a point or two over the next year. But the fact that the Fed has said that they would like to ease their monetary policy is cause to believe that rates won't be headed up over the next year at the very least. If you want to discuss the possibility that interest rates are going to top 20% in the next year, reach out to me. I would love to hear your opinion as to why you think rates could be headed above 20% and what that's going to mean for you and your family. I love hearing from you, and I am always grateful to be your local economist.